Financial Accounting Unit 1. In this unit, we basically are looking at the key fundamentals of financial accounting for non-accountants. We're going to define what financial accounting is, explain the purpose of financial accounting, the types of organizations, and who are the users of financial accounting information. Accounting begins from the Bible. To account is simply to take a record. To give an account means to keep records of. So if you go to Romans chapter 14, verse 12, the Bible says, or makes use of the word account. Each one of us will give an account of himself to God. So it's a biblical concept. So definition of financial accounting, according to CIMA, official terminology, is simply the recording of monetary transactions of an entity in accordance with established concepts, principles, accounting standards, legal requirements, as well as their presentation by means of an income statement, which is a topic we're going to delve in. The balance sheets and the cash flow statements. These will be made during and at the end of an accounting period. So, what is the purpose of accounting therefore? Accounting has a sole purpose of the following. Number one, to assess what assets a company owns, to assess who owes the company, to assess who the company owes, to assess how the company is financed, and also the performance of the company over time. These are the 5 key purposes of financial accounting. So, in fulfilling these obligations or purposes of an account, we must understand that account information is of interest not only to the businesses but also to other users of accounting. So in the context of accounting, accounting will take place within an organization. But what do we mean by businesses, and what type of businesses do we have? We have several types of businesses. We have what we call a sole trader, a partnership, a company, and a cooperative. Who is a sole trader? Like you can see, a one-man business who undertakes a business of venture where all the risks are absorbed by the individual. The decisions are prompt and easy to make. They only make one type of tax payment, which is called income tax. They can employ a few workers. They have a disadvantage of unlimited liability in the sense that these ones die together with the business. So the owner of the business is actually the business itself. So it graduates into another form of business, which is called a partnership. Partnership is governed by a partnership deed, which can either be oral or written. Partnership is a collision of more than one member. For professionals up to 20, like the lawyers and the accountants, they too have unlimited liability, meaning the creditors can reach as far as their personal belongings. In a partnership, every action of the partner is binding of the members. Advantages that you pool resources as well as expertise. Disadvantages are that in a partnership, long decisions are binding on the entire partnership. It graduates into a company which can either be limited and limited to family or to the outsiders. So we call them the public or private limited company. These companies are the most common type of business which is secure. They're distinguished by them being limited. They sell their portions of their company through what are called shares. Shares are small proportions of company ownership. These shares could either have voting rights or no voting rights, depending on the type of shareholder you could be. And we also have a cooperative, which is simply an entity where the members are the customers. They get to sell goods and services at a price that is fair in favor of its members. So I have talked about the characteristics and the advantages and disadvantages of each. Please find time to read in depth at your own. So Partnership, I said, there's a pool of resource and skill. There's risk sharing. No need for auditing. They don't need to publicize their financial statements annually like the limited companies should. The form of accounts are not regulated. They're easy to increase or reduce your capital. And the disadvantages are that they have what? Limited liability. They have dependence on each other and not capital. Company dies upon the death of any member. Company is a separate legal entity which assumes a certain legal personality. This company can either be private or public. In Zambia, we are governed by Cap 308 of the laws of Zambia, where a company shall be incorporated and assume a personal distinctive entity. Private is owned by individuals other than the public. It ends with the word limited. Public is one which ends with the word PLC. So both have a minimum of 2 directors and shareholders are required for a partnership. So now we graduated into now understanding who the users of account information are. There are several users of account information streaming from the internal to the external users. Under the internal users, we have the following: managers, directors, internal auditors, employees, and under the external, we have the lenders, shareholders, government, local authorities, analysts, journalists, competitors. We may have suppliers, external auditors, customers, the general public, and trade unions. These make external users of account information. But what information is needed? Shareholders need to calculate their future and current profit, security of their investment. They want to guard their shares jealously. Same with potential investors. If they need to invest in a particular company, you must be aware of the current and future profits. We have employees who are keen to financial account information because they want to be assured that their salaries are intact. Trade unions also are the representatives of the employees. So for bargaining purposes, they need to have understanding of financial accounting information so they could be able to bargain for what is available. Customers also need to know whether the company will continue to supply them. There's what we call stock out costs, where companies and businesses lose market because of bouncing. So customers would want to know the reliability of the company to supplying them with their necessities. Suppliers also, who are also creditors, want to know and have assurance of the financial health of the company. How able are they to supply them with goods, to supply them with money once the goods are sent to them on credit? Competitors also use this information to make economic decisions. Government agencies also need to know the economy and how it's performing for tax purposes. Managers, being internal users, also want to use for control planning and for uh, monthly forecast. Board of directors for strategy making. The lenders for liquidity, whether they want to know how you're able to pay them. So we have defined financial accounting already. You must understand that there's also what is used for internal use, which is called management accounting. This, on the other hand, is a process of identifying, measuring, accumulation, analysis, preparation, interpretation, and communication of information used by management to plan. So the distinction between the two can now be illustrated by a table below. Financial accounting is for both, it's for external users for decision making, whereas management is only for internal users for planning control. Financial accounting is for provided for using past performance during the year, whereas management accounting uses historical performance compared to the budgets plus projections of the future. Financial accounting is guided by company law and is predetermined by the predetermined financial standards, whereas management accounting doesn't use any format whatsoever. but as according to the discretion of management. And there are no legal requirements in this kind. Unit 2. This unit, we basically want to understand the conceptual framework for reporting. As per definition, financial accounting is the recording, classifications, of monetary transactions in accordance with what established concepts, principles, and accounting standards and the legal requirements. And this is the reason why the second part of our unit is important, because it spells out the regulatory framework. The regulatory framework comprises of three: the national company legislation, international financial reporting standards, and the stock exchange rules. Now, what are accounting standards? These are authoritative pronouncements that explain how to deal with specific what accounting problems, like evaluation of closing stock, measurement of property, and equipment. Why do we have accounting standards? To have a common form of content of accounts. It's important that if you go to the US, you go to Congo, you have the similar format. Now, these rules of accounting are prescribed by what are called accounting standards. The public sector is guided by what is called IFRS, which is the International Financial Reporting Standard, whereas the public entities like government are guided by the International Public Sector Accounting Standards, IPSAS. Now, these ones are important to know. When it comes to the private sector, like I said, we use the International Financial Reporting Standards. We have a list of these ones, starting from IAS 1, 2, 3, 4, 20. These ones have a description of what they do. Standard 2 looks at inventory. Standard 7 looks at cash flow. Standard 8, the policies and changes in estimations. You don't need to memorize these as such, but you need to know that they are all guided by these standards. Now, we'll go to the conceptual framework. What is the conceptual framework for financial reporting? The conceptual framework has said that there should be a comprehensive set of concepts for reporting to by the board. This conceptual framework provides guidance that underpins the decisions the board makes when developing these standards. The initial conceptual framework was issued in 2018, but later revised effective 2020. So what is the purpose of the conceptual framework? Mainly it is to assist to develop the accounting standards based on the concepts. It is also used to assist to prepare financial reports that are consistent with accounting policies. It is also important to assist all parties to understand and interpret these standards. So when we come to the conceptual framework in financial reporting, it has what we call basic elements that come as qualitative characteristics and also as elements. Now, this is our preamble into financial accounting. It's like the glossary of financial accounting. We need to understand the terms and what they imply. So we go to understanding the objectives of financial statements, basically so as to understand, to provide useful information to users in decision making. Now, a complete set of financial statements should include the financial position to balance sheet, the comprehensive income statement, the statement of changes in the financial position, the cash flow statement, and changes in equity. The elements of financial accounting include what we call assets, liabilities, equity, revenues, expenses, gains, and or losses. So now, what are assets? What are liabilities? What is equity? From your own term, what do you think these are? What do you think these are?
In the accounts
Mm-hmm.
that a company has, I think. That, yeah.
Assets are what?
The things that a company has will not, that a company owns.
That's correct. These are what we call economic resources owned or controlled by an entity like a company, an individual. They are measurable in nature. Assets can be tangible like cash, inventory, real estate. Assets can also be intangible like patents, trademark, a good name in terms of goodwill. These assets typically are categorized as current assets and non-current assets. So current assets are simply what we own and it can be easily converted into cash within a year. Whereas non-current assets are like fixed assets which are expected to provide value for more than a year. Then we go to the liabilities. What do you think are liabilities? These are obligations to pay. They are debts that a company owes external parties. So liabilities represent claims that an entity has assets or resources. The claims on our assets and resources. So liability can include loans, accounts payables, salaries, bonds. Just like assets, these ones also are categorized into two. We have what we call current liabilities and non-current liabilities. Current liabilities are simply Congolese that are supposed to be paid within a year. Non-current are Congolese that have maturities for more than a year. We also have what we call equity, which is also known as shareholders what? Equity or net assets. This looks or represents the residue interest that are in the assets. In other words, it is what is left for the owners or shareholders if all the debts and obligations are settled. So assets are part of equity sometimes. So equity can consist of various components like share capital, accumulated reserves, other reserves. So share capital simply refers to the amount of capital that is invested by the shareholder in the company. So it represents ownership in the business. Share capital is divided into common shares and preferred shares. Each of these ones have their own rights and privileges. We also have accumulated reserves. These ones are also known as retained earnings or profits. It's a portion of the company's profits that is retained or invested into the business rather than the shareholders getting debt elsewhere at an interest. So they'll plow it back. Those are called accumulated reserves. Other reserves will include contingent reserves, or where a company may have a surplus on the revaluations. Is all going to the reserves. When you sell a business, we make money on a disposal. Those are reserves. So basically, this is a glossary that you need to know when you're coming to basic use of accounts. What are revenues? What are expenses? What are gains? These ones are also important to know. Revenues are simply the income generated through a company by its primary objectives of selling a product or providing a service. These the increased equity, and expenses are simply the costs that are incurred by a company to generate what revenue. They are expenses that are debited in the ledger account. Gains and losses represent the increase or decrease in equity resulting from non-operating activities. So gains can increase equity, while losses can decrease equity. That is how it goes. So now we proceed to so I've explained each of these asset, economic resource controlled by the entity as a result of past events. Liability, an obligation to pay. Expenses, incurred because of our operating activities. Then we go to the fundamental characteristics. We have qualitative characteristics that are divided into two. We have what we call fundamental qualitative characteristics and enhancing qualitative characteristics. These ones need to be known. So what comes into your mind when we're dealing with fundamental characteristics? The fundamental characteristics include the following elements: relevance. When you're looking at information or financial information, it must be relevant in that it can influence economic decisions by helping to evaluate the past, the present, and the future. To be relevant, information must be timely and must be predictive. Another characteristic is that it must have a faithful representation. Faithful representation simply means that information should be faithful depiction of the underlying economic transactions. It can be complete and free from bias. When we go to enhancing characteristics, there are several. We have comparability, meaning it should allow the users of accounting information to compare across different entities over different periods. There should be consistency in the policies. That's why we need to have global accounting standards. So when financial information is comparable, it's easier for users to identify the trend, whether we are performing well or not. Timeliness. Timeliness simply means that information should be available to the users in a timely manner. Information that is outdated becomes irrelevant. So delays in reporting can reduce information usefulness. Understandability. This information must be clear and understandable so that the users can comprehend it without any undue effort. This includes a clear and concise language, avoid unnecessary jargon and complexity. Verifiability simply means that to the very extent of the knowledge of the users, the information must be faithful and be presented by underlying events. So this implies that there should be evidence to verify the information provided. So these qualitative characteristics are very essential in preparing financial statements, and they'll help us find out that this information is not only reliable but accurate. So these are the important characteristics that we need to know. I've explained each of these characteristics. Go to what we call underlying assumptions. There are 4 underlying assumptions which financial accounting thrives on. These assumptions can be explained as follows. To start with, underlying assumptions are very foundational principles that will serve a basis for preparing financial statements and also the accounting practices for business enterprises. These assumptions will provide a framework of how financial information is recorded, how it is measured, how it's reported. So there are 4 main assumptions. Number 1, reporting entity. This assumption is also called the entity concept or the economic entity assumption. It states that the business is separate from its owners. Other businesses or any individuals associated with it are distinctive. In other words, financial statements are supposed to be prepared for a specific entity or reporting entity. The financial transactions of any entity should not be mixed as those ones of the owners. So a business is a separate entity from the owners. So these are the 2 different legal entities. Going concern is an assumption which assumes that business will continue to operate indefinitely for a foreseeable future. This means that when financial transactions are prepared, they are assumed that the company will not be liquidated or forced to cease in the near term. So this assumption will allow for a historical cost accounting method which is used for assets. So it means or assumes that they'll continue to be used in the business and not to be sold in a distressed situation. The monetary unit concept is an assumption that assumes that all transactions and items that are recorded in the financial statement should be measured on a common monetary unit, such as a kwacha. This assumption simply simplifies recording and eliminates the use of other purchasing powers like gold that was used in the barter system. Periodicity concept or assumption simply asserts that from time to time, it is important that assets are recorded and reported in these meaningful periods. It could be years, months, quarters. Financial statements must be prepared for this specific time period to provide regular and consistent reporting for the company's benefit. This assumption facilitates the preparation of interim and annual financial reports. So these underlying assumptions are very fundamental to the practice of financial accounting, and they're critical to ensuring that there's reliability, comparability across all businesses that use financial reports. Are we together?
Yes.
Now, I've explained each of these concepts and what they mean. Then we have what we call principles. Those were assumptions. These are principles. What are the accounting principles? And how do we explain them? So there are 4 accounting principles, which are also known as the GAAP, the generally accepted accounting principles. They're a set of standardized guidelines and the rules that will govern accounting and financial reporting. These principles are consistency, comparability, transparency in financial statements. So here's explanation of these ones. The first one is called the cost principle, which is also called the historical cost. Now, this principle states that assets should be recorded in the balance sheet on their original cost, which means that the amount that they paid to acquire that asset is what we're going to record. Under this principle, assets are generally not adjusted to reflect the current market prices. So if you bought land at 50 kwacha, even now it must be 50 kwacha. So this principle will promote objectivity and verifiability. Revenue recognition principle. This principle simply outlines when and how revenue should be recognized or recorded in the financial statement. According to this principle, revenues should only be recognized when it is earned or realized unrealizable. So in simple terms, what I'm trying to say is that revenue should only be recorded when goods are delivered or services are performed. Payment is another issue. Whether you deliver today and they pay in 2 years' time, you record it today, because this principle will help match the revenues, expenses in the time in which they were incurred. We also have the matching principle, which is also known as the expense recognition principle or accruals concept, which states that the expenses should be recognized in the same period as the revenue, so they can generate in the same period they were generated. In other words, expenses should be matched with the revenue they're associated with. If a cash payment for expenses, for instance, if a cash payment for expenses occurs in a different period, this principle ensures that income statement reflects the true cost of generating revenue and provides a more accurate picture of the company's profitability. Disclosure principle is another principle which helps us as accountants to ensure that the financial statements accompanying notes provide all necessary information to allow the user to make informed decisions. This means that if you're not disclosing the basic financial data by adding additional notes, it may render the statement irrelevant. So full disclosure is very essential to help basic users of accounting information to make decisions effectively. So these users will be impacted in terms of accounting policies, contingencies, and related party transactions. So these accounting principles collectively, they serve as a foundation for financial reporting and accounting practices. By adhering to these principles, it ensures that financial statements are prepared consistently, accurately, and making them available for investors, creditors, and regulators to rely on this information for what? Informed decisions. So this is basically about these principles that have been explained in there. Then we have constraints that we have the cost benefit constraint, the industry practice constraint, a conservatism constraint. Now, a constraint is simply what? A limitation, a barrier, a blockage. Now, in the field of accounting and financial reporting, there are several constraints that are inevitably incurred, and these ones will influence or limit the application of the accounting principles that we've just been discussing and their standards. And these constraints are important to take note of. The constraints that we have are as follows. Number one, a cost benefit constraint. Cost benefit constraint. Now, what does this cost benefit constraint talk about? The cost benefit constraint basically, which is also known as the cost effective constraint, is simply a fundamental principle that states that the benefits of providing financial information should outweigh the costs associated in collecting it, costs associated in processing this information, the costs associated in presenting this information. So this means that in practice, we must endeavor to ensure that the accounting standards and practices should strike a reasonable balance between the cost of gathering and reporting financial data and the benefits thereof that are derived from having that information. So if the cost of providing a certain information is more than the benefits, it is impractical to justify us getting that particular information. So this constraint acknowledges that the limitations to the resources that a business can allocate to financial reporting. We also have the industry practice constraint. The industry practice constraint or limitation recognizes that certain industries and sectors have specific accounting norms and practices that they themselves have chosen to accept and follow within a particular industry. So while we have the GAP, which provides standardized frameworks for all industries, some industries have unique ways of handling. For instance, we have industries that are in the NGO world that have certain treatments that cannot be covered by the GAP. And so these are unique to that particular industry. And it may be necessary to deviate briefly from these generally accepted standards. So in such cases, a company within that specific industry would better follow what is within applicability, or that is within their application. All right, I hope you're following that. So
Yes, I am.
this is what I was just trying to elaborate. And the recognition is a process of capturing for inclusion in the statement of the financial position. So recognition is appropriate if its results is both relevant about the assets and the faithful representation of those items. So basically, this is where we end for our first 2 units. We'll continue the next 2 units later on. I hope this was clear and helpful.